Hi everybody, this is Alan Ellman, the Blue Collar Investor. In today's video we're going to discuss calculating our option returns using the Ellman System Options Calculator and specifically the multiple tab of that calculator. Before we get to the calculations, of course, we have to find the greatest performing stocks in the greatest performing industries and then determine the calculations or the profits that those stocks will generate. More information on these topics can be found at my website at www.thebluecollarinvestor.com or by emailing me at alan@thebluecollarinvestor.com. Now, once we have found the stock and we want to start evaluating it fundamentally and technically, we go to the IBD website, investors.com, which does require a membership. And once we get to the quote page, we scroll down. We're going to look at VPRT first. We scroll down past the chart. To the left beyond the chart, we see the Smart Select ratings. And that's a scan that IBD developed, which includes many fundamental and some technical parameters. And what we're looking for is we want all 6 of these green circles. We want all 6 of these circles to show green. If they show yellow or red, then they don't pass our scan. And the other stock that we're going to look at, MED, also shows those same 6 green circles under the Smart Select ratings. So we do run them through a few other screens, as most of you that follow my system know. And let's assume now that these 2 stocks we're going to look at, VPRT and MED, both pass those screens, and they in fact do. So the next thing we do is we go to www.stockcharts.com and we take a look at the technical evaluation of the equities. And we look at the exponential moving averages, and here you can see that the shorter term 20-day exponential moving average is above the longer term, with the price bars at or above the short term 20-day EMA. We take a look down here at the MACD. We see that's turned positive recently. And the slow stochastics also has come up above the 20th percentile and is now above the 80th percentile. And all these positive things happened on significant volume. So both charts look similar to this. Very strong technical charts. And these are the kind of stocks that we would want to put in our portfolio if the calculations were positive. So in order to find that out, we have to find out, how much cash are these stocks going to generate into our account if we did buy the stock and sell the option. So we turn then to the options chain. Now this is the options chain for VPRT, and you see here the stock is currently trading at 56.38. Now 56.38 is between the $55 and $60 strike, as most strikes trade in $5 increments between $25 and $200. Now I'm making this video with 2 weeks left in November contracts, so let's move on to the December contracts, which is 6 weeks away, and let's see how much cash we can generate. Now the stock is between the $55 and the $60 calls, so let's look at the 55. Again, this is VPRT. We see that it's trading at 370. We sell at the bid, buy at the ask. The bid is 370 for the 55 call and 170 for the 60 call. Okay, and for MED, I've already looked that up and I'll show you that in just a moment. So the next thing we do once we get this information from the options chain is we go to the calculator. And the calculator has a blue area and a white area. You could see I've already put in the information so we don't waste your time. And let me just review this information with you. For VPRT, the one we just looked up, we knew the stock price was $56.38. And the cash generated from the $55 strike price is $3.70. The expiration date on all of the options is the same, December 18th. Now for VPRT, had we sold the out of the money $60 strike, that you remember generated $1.70. Okay, And for MED Med, let's move this out of your way here. MED Med was $26.22, and the option price for the in-the-money $25 strike was $2.75, and for the out-of-the-money $30 strike was $75 per contract. Once again, all options expire on the same day, December 18th. So, if we were looking at VPRT, the in-the-money strike has intrinsic value of $1.38. We get that because the stock is trading at $56.38, and we've agreed to sell it for $55. Now, for the $3.70 option premium, of that, the $1.38 is really not profit, because when we sell our shares, if and when we sell our shares, we're going to lose $1.38. So that is actually deducted. The $1.38 is from the $3.70 when I calculate my option return of 4.2%. So I want you to know that the calculator will do that for you. It will deduct the intrinsic value for in-the-money strikes from the option premium, so you get a very real look at actual profit that you're making. And in this case, it's 4.2% over 6 weeks. We have downside protection of 2.4%, as that stock can drop in price from $56.38 down to $55, and your 4.2% is still protected. Now, if we sell our out-of-the-money strike, the $60 call, then we have an option premium of $1.70, which is all profit because we're not in the money, and we have an opportunity to make an additional $3.62 per share, because that stock can go from $56.38 to $60 or beyond, and then we'll make an additional $3.62. So our actual profit, the $1.70, is represented as 3.0% 6-week return. And we have a possibility of making another 6.4% if the stock does go to 60. No downside protection on out-of-the-money strikes. And Med is similar. It sells for $26.22. The in-the-money $25 call with intrinsic value of $1.22 will give us a real 6-week return of 6.1%. with protection of 4.7%, which means the stock can go from $26.22 down to $25, and our 6.1% profit is still protected. For the out-of-the-money strike, the $75 call, there is no intrinsic value, but the possibility of the stock going from $26.22 to $30, which would represent another $3.78 per share profit. So our real return is 2.9%, with a possibility of another 14.4%. That would be a total of 17.3%. Now, if you needed to pick just one of these strike prices to add to your portfolio, and the market was doing fabulous, and the technicals of the charts were great, you would probably opt for an out-of-the-money strike, which had the upside potential. And in this case here, you probably would opt for Med, because the returns are similar on the out-of-the-money strikes for the two stocks, 3.0 and 2.9, but Med offers you a much greater upside potential. Now, if the market was volatile or questionable, or the technicals were mixed on these two charts, then you would look for a stock with downside protection, one offering 2.4, the other 4.7, and you would tend to opt for the 4.7, which also gives you, by the way, a greater return of 6.1% compared to VPRT 4.2%. So when you put these stocks and different strike prices on the multiple tab page, you can hit print, and it'll actually print it out for you. You could take it right to your computer, and you can sit down and figure out which are the best strike prices, which are the best stocks to use for that month's portfolio. So there you have it, folks. The use of the Ellman system options calculator, particularly the multiple tab page, that's my favorite one. That's the one I used most of the time. And it will actually break down for you the option profit, the upside potential, and the protection that you get for the different strike prices. So I hope you found this video useful. Please contact me. Let me know your thoughts about it. I look forward to hearing from you. Have a great day, everybody.